Good morning, everyone, and welcome to Openpay's Q3 FY21 results investor briefing. My name is Jane Lowe, and I'm the Managing Director of our department, and it's a pleasure to have supported Openpay with investor relations through what was both a fast-paced and exciting quarter. Thanks to all who've made time to join this call, and we'll discuss Openpay's results for the quarter ended 31 March 2021. Presenting today will be Group CEO and Managing Director Michael Eidel. Morning, Michael.
Morning, Jane.
CFO Jussi Nunes. Morning, Jussi.
Morning, Jane. And
the company's US CEO and Global Chief Strategy Officer, Brian Schneiderman, who is joining us from his evening. Evening, Brian. The formal part of this session will be followed by Q&A. If you'd like to ask a question, you can do so at any time by entering your question into the Q&A function in the ribbon below. But without further ado, I'd like now to hand over to CEO Michael Eidel. Thank you, Michael.
Thank you, Jane, and good morning, everyone. Thank you for making time to attend today's Q3 FY21 results presentation. Our announcement yesterday highlighted several key achievements in the March quarter, so we'll try to paint the bigger picture, if you like, of how they contribute to the strategic objectives of our differentiated approach in Buy Now, Pay Later, with particular focus on our international expansion. In the period, we have made significant progress both in growing our business in our existing markets in Australia and the UK, as well as delivering on our strategy to position our company on the global stage and enable a step change in growth. Let me start with our business performance in the third quarter along our key indicators. Only late last year, we celebrated reaching 1 million active plans. Now, by the end of March, our customers have used our product 1.7 million times to meet their needs for life's important purchases, up 185% year on year. And the number of active customers for our Buy Now, Pay Smarter plans exceeded the 500,000 mark, up more than 100% from last year. And pleasingly, a record high 82% of new plans were generated by repeat customers. Meanwhile, and importantly, active merchants achieved the highest increase in numbers on record to 3,400, which is up 70% year on year. We have seen above average growth in our more recent vertical sports membership and in auto and health, where we make a true difference with our longer, larger and customized plans for the customer and for the merchant. This active merchant lead indicator is very important to us as it provides customers with choice and will be followed by accelerated TTV and revenue growth. Our key financial metric TTV has seen strong growth of 80% to $83 million. Our CFO Jussi will explain how this has translated into our P&L in his part. I want to provide now some more color to what have been the main drivers of these strong operating metrics. First, and I alluded to this already, regarding merchants, we won some major enterprise deals across our verticals, which drive usage and volume, including lately Officeworks in retail and Ford in auto. We went live with some of our major platform partners, Stack Sports and MSL Solutions in memberships, and now also Pentana in automotive, which is really, really exciting. We went into full-scale production with the health booking platforms My Health First and Pet Yeti, a veterinary platform, and we became the first Buy Now, Pay Later provider to enter the hospital segment via our partnership with St. John of God Healthcare. This all follows the pivot in our distribution strategy to focus really on wholesale merchant acquisition and to create large-scale, sustainable platform integration partnerships. If you like, building castles and moats to own whole subsectors in our verticals, like healthcare, dental, veterinary, to give one example. A strong contributor to our record high increase in active merchants was also the successful launch of Openpay's automated self-service program, which significantly simplifies the sign-up and onboarding, particularly of small and mid-sized merchants. Furthermore, we put significant effort into supporting many existing merchants who had become inactive during the periods of lockdown to get back to stronger business activities with our Buy Now, Pay Later product. I believe we have now the right approach in place to further drive our healthy mix of complementary high margin relationships in auto, health, home, education, and memberships, and high growth relationships in retail, to scale more quickly and to maintain our market-leading gross revenue yield, which has improved to 7.8% for the quarter and enables our pathway to profitability in the midterm. This was merchants. Secondly, in B2B, we have developed a strong pipeline of enterprise merchants who are not only very excited about our OP Pro software as a service platform, but also want to add a funding solution for the invoice terms which they offer to their business customers. To meet the market's demand for funded and unfunded solutions, and at the same time to enable Openpay and OP Pro to remain a capital-light, high-margin SaaS-based solution for Openpay, we signed a partnership agreement with Lumi Financial Management, an Australian provider of small business loans. Once it is integrated and provides a seamless customer experience, Openpay will facilitate the introduction of potential clients to Lumi for its funding solution on top of our SaaS product. This is very exciting, and we already have the first term sheets out in the market for this combined solution. At the same time, we are well on track to onboard Woolworths business customers onto our platform, and we see now the B2B revenue footprint increasingly in our P&L. Thirdly, our UK business continues to grow at scale. The big enterprise wins in Q3 were Monsoon and Accessorize. With a quarter-on-quarter increase of 15% to 250,000, half of our customer base is now in the UK. These highly engaged users of our budgeting tool, usually of an older demographic and with multiple Openpay plans already in place, are now the perfect stepping stone for our launch in our core verticals in the UK as well. This launch commenced during the quarter via a partnership deal with leading veterinary practice management software provider EasyVet, which will go live in the next few months, taking us into the healthcare vertical in the UK. In the March quarter, we have also taken some strategic steps to enable our next level of growth at a global scale. Firstly, as you are all aware of, we entered the US market with Brian Schneiderman becoming our US CEO. Since then, and over the course of the quarter, we have made massive progress with our 6-pillar US go-to-market strategy, particularly in securing a partnership agreement with a world-leading payments processor and extending our well-established partnership with EasyVet, which I mentioned before, also into the US. Brian will provide us with an update this morning. And secondly, we executed a $67.5 million funding package, including a $37.5 million placement, a $25 million corporate debt facility, and a $5 million share purchase plan, which is currently open to shareholders. The sole purpose of this raise is to accelerate our international expansion, particularly in the US, but also in the UK, where we have started to enter, as I said before, our core verticals, and UC will provide more color to our Q3 funding position. To conclude on that part, we are very happy with the company's strong execution on our strategic initiatives and operational performance in Q3 FY21, and we are well set to deliver a strong Q4 and overall financial year 2021. I will now hand over to our CFO, UC, who will discuss our financial position in more detail before Brian provides more flavor to our progress in the US. Over to you, UC.
Thank you, Michael. Good morning, everyone. So Michael outlined a number of exciting initiatives and updates that support and really accelerate our strategy around entering the next stage of global growth at scale. This included the signing of significant partnership agreements in all regions, which Brian will also touch upon shortly. It included broadening our B2B offering now also towards funded SaaS or software as a solution solutions, as well as a significant funding package to support this ongoing growth. So what I will do is briefly to review the financial outcomes for the quarter. I will outline their main drivers, as well as provide some direction as how we intend to deploy the proceeds of our recent funding package. Okay, so starting with TTV, Michael mentioned that we grew volumes by 80% in comparison with this time last year to end up at roughly $83 million generated from all of our verticals in all geographies. This volume generated revenues of $6.6 million for the quarter at a yield of 7.8%, which we expected after the low margin, higher retail volumes recorded in the second quarter, so October to December. Also, whilst still at an early stage of growth, very pleasingly, we noted an uplift in SaaS-based B2B revenue during the quarter, which we expect now to ramp up, as we onboard more B2B merchants and customers. Similarly, as Michael mentioned, soon we'll be able to offer our funded SaaS product that Michael just mentioned, which is supported by Lumi. And very importantly, and so far we're seeing that the strong demand for B2B products, whether unfunded or funded, we see this as a real positive and a key piece to maintaining our path to profitability through healthy revenue margins. And of course, look forward to reporting progress in this space as well. Right, then from portfolio losses perspective, we recorded a net bad debt rate of 3.3% for the quarter, mainly due to some early stage losses experienced within the UK, although which are already showing signs of improvement, as well as some seasonality in TTV that impacts the ratio. I can touch upon that a bit later. This translated into a quarterly net transaction margin, or NTM, of 0.1%, which is now expected to increase or improve to more normalized levels in line with improvements in loss performance hereafter. Okay, finally, really, I just wanted to touch on the uses of our recent funding package, totaling an expected capital and corporate debt amount of 67.5 million once the share purchase plan, or SPP, is finalized. And again, really to reiterate that it supports our strategy of global growth at scale. The funding will mainly contribute toward merchant acquisition in all geographies, both B2B and selectively B2C, B2C and selectively B2B. In the US, the funding will allow Openpay to develop organizational capability to further support our market entry and acquire key initial aggregator relationships, whilst also supporting funding for early TTV growth. Brian will talk a little bit more about the latest progress within the US shortly as well. And what I just want to do is really just to briefly summarize the quarter from my perspective and financials, which is number one, portfolio growth performance continues at strong pace with top line growth and profitability margins as per expectations. And then importantly, secondly, we've already started to see a reversion trend toward more expected and normalized net transaction margin levels from improvements in loss performance during Q4, as in April already as well. Okay, next over to Brian, who will update us on the progress we're making in the US and to provide us some further context around the rollout of the OP strategy there. Over to you, Brian. Thank you.
Thank you, Jussi. Good evening, good morning, everyone, wherever you are. As Michael mentioned, we've made quite significant progress and success with our strategy in the US, what we call our 6-pillar strategy. In fact, the US is precisely on schedule with very material progress in every one of the 6 pillars that we promised all of you, our investors, on our call in December. We've also made great progress with signed contracts, contracts that will provide us with a lot of deal flow and will provide actual US revenue flowing in the second half of this calendar year as the merchants and the aggregators that represent thousands of merchants each start to go live. Again, that's coming in the second half of this calendar year. The first that you're going to see is the healthcare providers, quite a number of, in fact, I'd say thousands of dentists that will be coming online, and vets across the entire United States. We expect that these will be followed by an online marketplace, and after that, the quite massive deal flow that we plan under our agreement with that world-leading payment processor, a company you all heard us recently announce, that has over 1.2 million merchants, and importantly, with whom we will be accessible in their online as well as their point of sale systems. those that are already in place today in not just the US, but all the global markets where we operate today. I want to be really clear about the size of this market here in the United States that we're about to go live in, and the significance of our relationship with that large processor that serves that market. So the US represents a $829 billion US dollar market opportunity for us. $829 billion market opportunity. I'm going to break that down for you. The first I want to talk about is healthcare, and that is our, as I said, our first in-market opportunity where we're already signing and have very late stage deals that will be going live in the second half of this year. That's about 218 billion US dollars as a market. The second, home improvement, 78 billion US dollars. Third, education services, that's 89 billion US dollars, and then followed by 65 billion US dollars in auto repair and maintenance. This is the market, as I've said before. It brings an entirely different level of scale to Openpay. And then finally, as we pivot to the big ticket retail, particularly with those customers that we've gotten to know and have a low level of risk, having originated them in those four verticals, the big ticket retail market is $379 billion. Our partner that we announced gives us unique access and positioning to take these very significant market share opportunities with our highly differentiated product. This is the only product that that partner is offering that can address the demand at their merchants for larger, longer term, and interest-free loans. Very significant. We talk a lot about differentiation at scale. I want to provide a little more clarity on what we mean by that. In the US, we sit in a very special place with very few competitors. It's really what I consider the buy now, pay later 2.0 space, or the next generation, next gen BNPL. This is where there's only a couple of buy now, pay later providers that play in offering these larger term, longer, closed-end installment loans that charge no periodic interest rates. And there's a lot of demand for it, but there's not much product. And so it's really one of the reasons why I joined Openpay, is because the demand is significant in these categories. Within that buy now, pay later 2.0 space, we strongly believe that we're the single most consumer and merchant friendly option. And that's something that has ingratiated us with the regulator, as well as the largest merchants and aggregators that represent very large numbers of merchants in the four primary verticals that we talk about. Being verticalized makes us even more unique, where we're integrated into the technologies that are most commonly used by these verticals, like patient management systems at the veterinarian clinics, at the dentist offices, and at the hospitals. The patient's experience is frictionless, which drives up adoption significantly. We have recently signed the CEO of the Merchant Advisory Group as our first member of what we call the OMAC, OB's Merchant Advisory Council, and we're the only BNPL to do that in the United States. The Merchant Advisory Group, if you're not familiar with it, is the most significant, influential merchant group for payments among the merchants in the United States. So we're in a very unique and a very, very strong position in the world's largest consumer market, where buy now, pay later is growing very rapidly and has lacked what it is we offer for those larger term loans. Our strong 6-pillar strategy is successful. It's working, and it positions us for an incredible launch in the second half of 2021 when our technology here goes live. I'm looking forward to updating all of you on our progress over the next few weeks and months, and I'll now hand it back over to Michael to give us his closing remarks.
Thank you, Yusuf and Brian. So as you have heard, and just to wrap up, the March quarter has delivered some really very strong operating and financial results across all the areas of our business. And from our perspective, provides us with a very healthy basis for further accelerated growth from there. We recorded a very strong month in April, as Yusi mentioned, which provides us with great confidence that we will end the financial year with excellent business performance. The launch into the US, as outlined by Brian, represents a opportunity for our business, with OP first launching into these sectors, as mentioned, in buy now, pay later, and then following into B2B as well. This is with a directly addressable market size of, to repeat Brian's number, $829 billion in the verticals where we have a unique value proposition. And maybe different to any other markets in the US, we can really focus on one vertical to start with, like healthcare, dental, veterinary, and address a massive volume opportunity. And this means we can really build moats and castles to not only grow at scale, but defend, to kind of develop very long-term defensible market positions in these areas based on technology integration and just the best product in the market for merchants and for customers. So we are convinced that our differentiated, longer, larger, customized product in our key verticals, our distribution strategy based on strategic partnerships, and the launch into the US will set us up for the next level of scale and growth. We will work with enterprise retailer, as mentioned, payment processors and banks. We will integrate further into large business platforms with critical masses of customers accessible in one hit, if you like, to create this highly defensible market position. We will use product innovation to engage our customers, and we are strongly focused on our geographic expansion with the US and the UK. We see also an increasingly commoditized buy now, pay later sector now, with loads of pay in 4 plans in fast-moving consumer goods. We also see heightened concerns from regulators about the irresponsible behavior of some providers in promoting their product. We strongly believe that Openpay is the better alternative, providing finance-savvy grown-ups with a smart budgeting tool for their important investments and those of their families. We look forward to keeping investors updated on our progress, and thank you for your support. And with that, we will now enter the Q&A part of this call, moderated by Jane. Over to you, Jane.
Thank you, Michael, Yusi, and Brian. I'd now like to open up the session to your questions. If you'd like to ask a question, please type it into the Zoom Q&A function in the ribbon on your screen. We've got about 15 minutes. If you do have a question that we don't field in the time that we have, as always, please feel free to send it through to investors@openpay.com.au after this session. So let's start off with a question about the US, and Brian, I might put this one to you. So how confident can you be that you've really hit the market with your product in the US?
Yeah, it's a great question. So I'll start off with, I've been in this market focused on payments and lending for 33 years. There is a void in this market. It's one of the reasons, as I mentioned, that I came to Openpay. The market just didn't have this product. The second thing I'll point out is, if you take the words of the very, very progressed deals that we're working on, I'll give you a couple of quotes from one of the dental service organizations that represents over 1 million consumers in the US. They said that this product is going to be incredible. And I think they said, our customers are going to love this product. It's that different. That's pretty significant. Hopefully, in future weeks, I'll get them to come forward and you'll actually hear it directly from their mouth. I'll share a very personal confidence level. I just made, my wife and I, a very significant personal investment in Openpay. And so I wouldn't be doing that. After all, I've already risked coming here as a former partner for one of the largest accounting consulting firms in the world. I'm actually investing myself significantly. Very confident.
Excellent, thank you. And so that's a pretty strong response from you, Brian. So just with regards to go-to-market approach, again, this is a question for the US. So can you just re-encapsulate for us, what do you see as kind of next steps?
Well, so for those of you that have been following along, we have a 6-pillar strategy that we promised. The first was to recruit the strongest team in the world in buy now, pay later. And if you look at the biggest market in the world, as I've said, it is the US. We've brought on board the US representative that wrote the policy at the regulator to become our Chief Product and Compliance Officer. He is very actively, Gary Stein, very actively making great progress getting the product ready and Americanized, as we say, for all the regulations. But we've also been standing up the Merchant Advisory Council. So we've been making that product exactly tuned to what the US merchants in each of those verticals want and need. So it's a product that they feel they created for them, by them. I want to reiterate, we keep telling you that we've got this 6-pillar strategy. These 2 of these pillars are so critical. The first is that we're launching this wholesale merchant strategy and distribution model. When we sign one of these deals, we're not signing one merchant. We're signing thousands of merchants. One DSO, dental service organization, will have anywhere from 800 to 1,100 dentists. So we actually are signing all of those at once. That's the aggregator. That's the wholesale approach. And that represents at about 1,000 to 1,500 patients each. That's over 1 million patients just in one DSO. And we are in very advanced discussions with many DSOs and other aggregators in the dental and other healthcare industry. As you know, we've got EasyVet. That's another example of a wholesale merchant strategy. These large-scale ecosystem partnerships, that's a 4th pillar that we talked about. That is an example of that is the recent deal we announced with the largest processor in the world with 1.2 million merchants. They will not only have the ability to start processing and accepting our Openpay product at their point of sale and online, there's incentive structure. So they actually become an extension of our sales force. Very, very significant. So you'll be hearing more about what that means, how it's rolling out. You'll actually start to see the deal flow in not too far future in the second half, 3rd and 4th quarter. And then you'll see us pivoting to larger ticket retail, particularly for those verticals that we sequenced that I discussed earlier. A lot of progress you're going to see happening over the next few months. Very exciting.
Thank you. And sorry, Michael and Yusi, I hope you don't mind, but another quick question for Brian, since we're on the US. Thanks, Ben Skender, for this one. Can you talk about the expected trajectory of revenue margins as you bring more US customers onto the platform?
Well, one of the things I want to explain about the strategy in the US, the margins and the strategy in the US. Michael talked about building castles and moats around these verticals by being deeply integrated, for example, with the healthcare patient management systems. In the US, it's such a big market, such a massive market, that these verticals alone offer us enough opportunity that we don't have to try to be everything to everyone. And if you look at the competition in this space, in general, that what they're doing is offering everything to everyone in every vertical. That means that they have to subsidize the losses that come, the high levels of losses that come from verticals that we won't touch. That translates in the US to actually better margins because we're very focused, not just, by the way, on the vertical level, but the sub-vertical level like dental within healthcare. And if you look at our loss rates, they're extremely low. So we're getting more of the product we want. We're getting more of the customers we want, which is going to enhance our margins in the US. And the key there is not only to differentiate within these very thin verticals that are massive in the US, but then to do it at scale so we can get our cost of capital down. How do you do that? Through these aggregators, through the ecosystem partners, by not going merchant to merchant, knocking on doors, but bringing in thousands at a time. So that translates to much better margins and differentiation, as I say, at scale. So Yusi, anything you want to add to that?
No, I think that, Brian, that's really well answered. And, absolutely, I think we've spoken about these margins already in previous calls that, we do expect them to be there at the higher single digits and longer term, hopefully low double digit, but, good healthy margins, not just top line, but in net transaction margin space as well. Absolutely, well answered.
Thank you. So let's switch tax geographies. So Michael, obviously there's been quite a lot of growth in the UK. So how important do you see the UK business? I might put that to you.
I think we have now, with the geographic footprint in our home market, where we are really very far progressed in kind of covering really the industries where we can extract most value and add most value to merchants and customers, and now the UK and the US to follow very soon. I think that's now, for the time being, really the footprint for us geographically to deliver our differentiated product and scale. And the UK plays a very important part to this. As we know, we have entered the UK 1.5 years ago. We have been growing very, very significantly, and we are now at the point of entering, based on a very, very strong active customer base, now also these verticals which we will take with us into auto, into healthcare. And I think this is a very, very promising opportunity. The UK market is around 3 times the size of the Aussie market. So for us, also very, very important besides our home market, Australia and the US.
Thank you. Okay, so we might switch to a couple here just on financial matters. You see, we might start with the low net transaction margin for the quarter. So the question is, can you comment on the low NTM for the quarter and whether this is expected to be persistent?
Yeah, look, what I might do is the NTM for the quarter is quite linked to a loss performance. So I might kind of start with that question first. And, touching on what Michael was talking about, very strong growth in the UK and it being an incredibly important part in our growth strategy, that is correct. And if you look at the main contributors, there are some early stage losses that we've noted in the UK, although which have already started to improve quite significantly. And if you think that, losses, it takes about 3 to 6 months for those to roll through the books. And if you actually compare it to, Q3's TTV, there's also a little bit of timing kind of nuances there as well. But effectively, early stage losses that are already now improving. If you look at the actual year-to-date loss rate or net bad debt rate, it's still below the 2.5% where we want it to be at 2.4%. And we expect that to be managed from here on onwards. And if I take that back to net transaction margin with our good, healthy revenue margins, it's really just that kind of timing impact of having that 3.3% loss rate for the quarter. So we also expect that net transaction margin, no, it is not persistent. It will improve now as loss performance improves as well.
Great. Okay. And Michael, perhaps back to you. Some interest in the relationship with Lumi. So 2 questions here. One, more generally, can you please speak about that relationship? This is obviously referring to the B2B product, OPY Pro. And then the other is whether you will receive any introducer fees from Lumi on top of the SaaS revenue you are making through OPY Pro clients.
Yeah, that's 2 great questions, and I will kind of answer them in one. First of all, we have seen now recently building our pipeline for our software as a service product, a very, very strong demand, but definitely buy now, pay later, if you like, has also reached now B2B. And there was a heightened demand also for not only our unfunded solution, but us also bringing a partner on board who can provide funding for the invoice terms, which large enterprise businesses offer to their business customers. And this has led to this very, very exciting partnership with Lumi, who brings now this funding capability, a strong balance sheet to our software as a service product. And what the agreement is going forward as we build the pipeline and sign more deals, we will introduce Lumi to these enterprise retailers as well for the opportunity of a funded solution. And we kind of make it very easy for the enterprise retailer through the integration of our 2 platforms, Lumi's and ours, OPY Pro, to provide a seamless experience for the enterprise merchant and their business customer. For unfunded, through us, very clean as We have talked about this in the past, and now if they want also for a funded solution. I will not speak into more details about kind of confidential commercial terms with Lumi, but there is also a fee for us as we successfully introduce Lumi to these enterprise retailers on the back of our software as a service OP Pro platform.
Excellent, thank you. Okay, question I put this to UC, perhaps on funding runway. So obviously there's been a recent funding package announced. Can you just talk to what the current funding runway looks like?
Yeah, no, thank you. You're very, very important question, Jane. And you know, as an organization, we've been very, very happy with the support that we received on the capital raise, and have continued to get through the SPP. So on both fronts, and you know, which has translated, you know, that you know, we're very comfortable with our funding runway in the medium term. You can see a little bit more detail in the actual 4C around that as well. But look, in terms of exact runway, I would say that then gets, to get that more accurate, really depends on really the pace of growth in the US and with some of these things in the UK as well. So, but at this point in time, for the medium term, we're very comfortable with the runway.
Great, thank you. Couple of questions on recent agreements. So on EasyVet in particular, I might put this one to Michael. When do you expect EasyVet to launch in the UK? And then a similar question about launch in the US.
Yeah. First of all, EasyVet has been a very strong partner for us for years in Australia. And basically, we will build this partnership in the UK and in the US on the same technical platform integration, if you like, which they use globally. So this effort to integrate will not take as long as it otherwise may. So we expect both the launch into the UK and into the US with EasyVet happening in Q1 FY22. And again, with the proven also way how we kind of support our mutual solutions through marketing and then customer acquisition, I think we will see then strong growth quite immediately.
Okay, excellent. I'm watching the time. We're pretty close to our wrap-up time, so I might just add this one in as the final question for you, Michael. So there's a lot going on in the business at the moment. So how can you make sure that you're playing to your strengths in each of these different geographies?
Yeah, I think we have a very, very clear strategy what we focus on from our core product, which is longer, larger, and customized to the needs of merchants in respective industries down to the individual level, but being able to scale it. And with that, really reach into areas where we see much, much less competition than in the typical fast-moving retail t-shirt and tennis shoe space with Pay in 4. And we do everything from a technical development perspective in defining our kind of distribution strategy, focusing on wholesale partners, on platform aggregators, to really focus on these verticals where we can make a true difference to both the merchant and the customer and the partner, by the way, maintain our healthy top line margin and create operating leverage through scale to make this a profitable business in the midterm. And as mentioned before, building this castle and moat to create a long-term defensible position, which I believe many of our competitors don't have because they're kind of me too and quite exchangeable. So I believe this is really the strong focus, and we do everything to that purpose. And I think with the innovation into B, now also with this partnership with Lumi for funded solutions based on our software as a service, we have a beautiful opportunity to kind of, based on the same capabilities and focus, to extend our offer into B2B in a highly value accretive way. And this gives us a lot of confidence, also feedback from investors, partners, and clients and customers that we are on the right way to create long-term shareholder value. That's what we are here for.
Excellent. Good answer to wrap up with on a positive note. So with that, I might just say, actually, we did have a few questions that we weren't able to get through in the time. So please feel free to send them through to me via investors@openpay.com.au. And we'll get back to you. And with that, I'll hand back to you for closing remarks, Michael.
Yeah, thanks, Jane. And thanks, ladies and gentlemen, for joining us on today's call. We are very much looking forward to updating you on our progress again soon. And I acknowledge, I think for our investors, particularly in the retail space, and I know many of those are on the call and have been very, very loyal partners for us, supporting us very strongly. I know this has not been an easy ride over the last few months with the share price development, which in my view has affected, I think, the whole sector. But we, as I said before, my team and we are brutally focused on delivering on our promise and growing this business at scale. We all have put personal money into this company in the recent capital raise, and we are absolutely convinced that we have the recipe for growth and scale to make this a great business for the long term. And we are very excited to have you on board and supporting us over time. And with that, wish you a good day and thank you for your support.